This is our annual employer meeting for March 2022. This is very strange because I can't see anyone that's joined us virtually, and I can just see the 5 people that have come and joined us in the council chambers today. I'm Jo Ray. You probably all know me or have heard of me because I've been around forever. So I'm head of pensions and my responsibility is for the pension fund kind of on a day-to-day basis. I'll start off with an apology. Those that requested I send them out biscuits, I've not done it. You needed to come here if you wanted the biscuits. So maybe next year. This is being recorded. And we will look to try and share this on the website after the event, assuming the technology allows us to do that. So the agenda that we've got today, I'm going to give an update on the Lincolnshire Pension Fund, what we've been doing. Then we're going to hand over to our fund actuary, Barry, who's going to talk us through the 2022 valuation, the process, what to expect. I won't give any spoilers there. Then Joshua Drotliff, who some of you may know, is going to cover the data submission and payments. This is kind of our annual soapbox, trying to get our employers all to do what we need them to do. Then we have Matt from West Yorkshire Pension Fund that's going to give an update on the shared service governance that we have with West Yorkshire Pension Fund. Then Amy, again from West Yorkshire, is going to give an administration update. There will be time for questions throughout, so please interrupt, but there'll also be time at the end. So this is your meeting, so please do ask questions. I didn't get any feedback on the topics that people would like to hear from. So particularly on the LPF update, you're just having to settle with what I think is important that you need to know. But please, at any point, if you want to hear about stuff, please do get in touch because we can share information at any time, not just at annual meetings. If you're in the room and you want to ask a question, please can you switch your microphone on because it won't be picked up on the virtual meeting if that's not on, and then turn it off afterwards. For those of you that are online, if you can please keep your microphone on mute if you're not asking a question, and if you want to speak, if you want to ask a question, you can either type it in the chat or put up your virtual hand and Claire will then raise that for you or invite you to ask your question. So starting on the Lincolnshire Pension Fund update, and just a reminder, you are in the Lincolnshire Pension Fund, not West Yorkshire Pension Fund, just to clarify that one at the start, because we still do have some employers thinking that you're in West Yorkshire. But I thought it would be helpful just to give an update on what we've been doing over the past year. So these are the areas that I'm going to look to cover. How we've been performing over the past few years, how we're invested, what's been happening with Border to Coast. I've been talking about the asset pool for a few years now. Then a bit on stewardship, which is an ever-increasing area of interest, how we're trying to be responsible investors within the fund. Then a bit about our annual report. It was published in December and it covers all areas of the fund. And it wouldn't be an annual meeting if I wasn't going to get on my soapbox and do a bit of nagging. So I will just be reminding you all what you need to do if you're looking to outsource any services. And then finally, just our current thinking on insurance arrangements that we have within the fund. So to start off, it's been, as you'll all be there, a very interesting couple of years with the pandemic, how it's impacted markets. In 1920, when it all started, the fund fell in value by 5.8%, most of which was in that fourth quarter as COVID hit us. And we closed the year at £2.2 billion. 2021, we recovered all of that and more, increasing the value of the fund by over 23% to close at about 2.7 billion. So we more than made up for the previous year's loss. And as at 31st of December, we're up over 16% on the year at over £3 billion. So this slide just shows the 1, 3 and 5 year performance. And as you can see, we're ahead of our strategic benchmark, shown here as the index, across all those periods. A very good year over the last year to the 31st of December with some of our external managers. So I was hoping to be able to say that it's a valuation year. We're hoping that things will continue this way and look really good, but obviously current events have really shaken the markets. But I'm sure Barry will cover how the valuation process deals with issues such as we're having now. So we have a diversified portfolio. We don't put everything into one area within the investments. We need to make sure that it's diversified across asset class, across currencies, across geographies. So just here to give you a brief update on how the fund is currently invested. So we have over half the fund in equities. So these are company shares. So this is probably the riskier end of the market, across 3 different managers there. Then we have 12.5% in fixed income. So this is company debt or government debt. So bonds is another word that they're called, and that's across 2 managers. Then a sizable chunk in alternative investments. So these are anything that your plain vanilla investments. So things like private equity, private credit, infrastructure, hedge funds, all sorts of different things that are in there. And if anyone wants more information on that and has a real interest in how our investments are managed, then we can always share more information. On the property side, we have 10.5%, and this is across various funds. Sorry, could I just ask if everyone can make sure that their microphones are muted, please, because there's some noise in the background. Thank you. Property, so this is more in UK commercial property funds. We don't really have any direct property. We've just recently, over the past year or so, started investing there in residential property. And then a small allocation to cash, and this is managed within LCC's own cash team. So the bulk of our assets are in return-seeking investments. And as I say, I've been discussing asset pooling since I think it was about 2016. This is the government initiative where we were told that we must pool our investments with other LGPS funds, and we created Border to Coast along with 10 other LGPS funds, and that went live in 2018. So we've now invested over half of the fund's assets in their funds. So there's a lot been gone on over the last couple of years to do that, and there's still more to come. We're looking at moving into a property fund towards the end of this calendar year, on the global overseas side, and then into UK property with them in 2023. And alternative investments, Border to Coast do have a suite of alternative investments, but we currently still use Morgan Stanley, and we're still looking at where the best place for our allocation to alternatives is. So there will still be more money over, but we're kind of meeting our requirements at this point, and the investments with Border to Coast are generally all doing very well. So now just moving on to stewardship. Again, over the last few annual meetings, we've done presentations on stewardship and responsible investment, ESG, all these different phrases. It's an area that the interest is just growing there from all of our stakeholders. You know, in private sector, DWP have brought out requirements of what pension funds have to do in reporting on how they're investing, reducing their carbon, etc. So stewardship and managing the money responsibly is an area that is not going to go away, and we have to be more and more transparent in what we're doing and how we're doing it. So these are some of the things that we do as a fund, and this information is generally all available on the shared service website or in our committee papers. So the pension committee sets its own responsible investment beliefs, and we had a training session just a couple of weeks ago reviewing those and making sure they were still fit for purpose. And that kind of sits around all the investment that we do. We have investment beliefs, and within that RI beliefs, and the E, the S and the G, the environmental, the social and the governance side, just sits across how we expect all managers to invest and how we invest ourselves. We also have an RI policy and voting guidelines. Now, we don't vote ourselves personally, as we don't manage any of the money anymore, but this is how we expect Border to Coast to vote, and we create this alongside Border to Coast and the other 10 partner funds to set a structure so it's very clear and very open as to what we expect companies to do and how we will vote if they don't meet those standards. We do stewardship reporting, so this is a quarterly report that now goes to the Pensions Committee, and we've also submitted a stewardship code statement, which is something that Financial Reporting Council manages, and we're waiting to see whether or not our statement has passed their rather high hurdles. We were hoping to have had something back from them by now, but we haven't yet. So again, that sets out the stewardship code now actually sets out not just our policies and what we say we'll do. We have to give examples. We have to evidence that we're actually doing what we say. So again, that whole transparency agenda is right up there in everything that we're doing. And then the net zero target and climate policy, we're not there yet. We haven't yet set a net zero target. It's something that we're looking to do this year. Border to Coast set one last September for 2050, their target for being net zero. So we're looking at that. We'll be looking at that at various meetings throughout this year, and setting out a climate policy is what we're going to do to ensure that our investments can meet a net zero target that we set. But I would be interested if anyone as an employer, if you've had any interest on this. I know some councils have had letters and questions about fossil fuel investment, etc. But I didn't know, as I say, it's something that's on every single conference agenda, seminar agenda that we have within the pensions world. And I didn't know if it was something that any employers needed more information from as to what we do, or had any questions. So shaking heads in the room, and I'm going to assume there's no hands appeared. Oh, well, if you do, we can always point you in the direction to let you know, and your scheme members within your employment know what we are doing to try and make sure that we're investing responsibly. So, annual report. So this is a document that we have to produce by statute, has to be published by the 1st of December every year. It includes a lot of information. I'll first ask, has anyone read it? Oh, we got a hand up and a nod. Now, I don't know that Steve counts because he's on the pensions committee, so I would expect him to have read it, but absolute brownie points for you, Peter. It is just a mere 206 pages, so won't take you too long, but I think it is a really useful place if you just want an overall view of what are we doing. You know, we're taking your money every month as employers, we're investing it on behalf of your scheme members. So, you know, as a stakeholder, as a major stakeholder, really, you should have an interest in what we're doing with that. So some of the things that are included in there, obviously the report and accounts, again, statutory requirement to have that in there, and the auditor's opinion. So you'll be pleased to hear it was unqualified again. So, you know, we are managing your money and reporting it all correctly. Our pension board do an annual report every year covering the work that they do. So they're kind of the oversight body for the fund. So you can see exactly what they've concentrated on, if they've got any concerns on anything that we're doing or the administration service is doing. The investments and the stewardship, you know, I've very, very briefly run through how our investments are managed and what we do on stewardship, but there's a lot more detailed information in the report on that. We have lots of facts and figures about the administration of the fund and the work that our shared service partner West Yorkshire is doing for us. So KPIs, all the standards that they're meeting, and lots of other useful information there. And then pages and pages of policies that we have that unfortunately we have to put in there. We'd like to just give you a link, but we do have to actually put them in the document. But I would, you know, I think people often don't think about it, but I think it is actually a really useful thing, even just to skim through so that you've got an idea. You know, we say we are taking a lot of money from you to make sure that we are managing it properly on your behalf. So As I said, it wouldn't be an annual employer meeting if I didn't get on my soapbox and do a little bit of nagging. So the soapbox for today is outsourcing services. If you are outsourcing any services and it involves a transfer of staff, so a TUPE transfer, then please, please, please get in touch with us before you go out to tender. As early as possible, months and months in advance even, because we can help you with so many things here. We've had a number of employers recently that have outsourced services, particularly small catering or cleaning services, and we haven't known about it sometimes until months after the event. Now, this puts your scheme members at risk. And that's what we don't want. We don't want one of your members to have a serious event, an ill health, a death, something horrible happen, and we find that they're in this black hole because their pension hasn't been considered properly. So I did share our pass-through policy back in August 20 with all the strategic contacts. And it's also on our shared website with the other fund policies. And this sets out how we expect admission bodies, so these are your contractors basically, how they should come into the fund. And the pass-through arrangement is something that a lot of funds are doing now, because historically there have been issues with large cessation costs when a contractor leaves. Suddenly they're faced with a hundreds of thousands of pounds, sometimes millions bill that suddenly they have to find and they hadn't thought about. They have uncertainty of contribution rates from valuation to valuation. With pass-through, this stops all that. So what happens, and so the documents are there to help you and explain it, but basically you agree the rate, so it's all there in the information for when you go out to tender. And there's a minimum rate that the fund will accept, so it's not just any rate that you decide, but it's all set out as to how that's done, and you work with us to agree a rate, and then they can pay that for either the length of the contract or it can be readjusted at valuation. That's a decision for yourselves as the employer. But what that does is that gives certainty for the contractor. They know what they're going to pay. They don't have to inflate their prices to cover that risk of what might happen with the pension costs. So they have complete certainty. And at the end, there are no surprises because those assets and liabilities fall back to you as the ceding employer. So it really removes a lot of that risk of contracting out services. And what you do within your contract or as a side document, you agree what risk that you expect that contractor to take and what risk you're happy to take. So we just need to see that that information's been discussed and agreed. And it does just make it so much simpler for suppliers, so much simpler for the continuity of the pension provision for your scheme members. So if you are considering outsourcing or you've got a contract renewal coming up and you're going out to tender and it might change, please, please get in touch with us, and we can make sure that you have everything in place before you go out for that contract. And as I say, we really need to make sure that we protect the scheme employers and we protect you and any employers coming in from having nasty surprises. So the last thing I wanted to discuss was the insurance arrangements, and apologies, it's a slightly grim subject here. It's kind of all about death and ill health, but as you'll be aware, there are some events that can have a really major impact on your liabilities. Things like pension strains on redundancy, ill health retirements, and deaths in service. Now, some of this is in your control. So redundancy strain, you're invoiced for that cost when it happens. You'll have had the figures when you're making that decision as to whether or not you're going to make somebody redundant. So that's completely within your control. The others are out of your control, and you don't see an immediate invoice, but the value of some of those events can hugely impact your liabilities and therefore your contribution rate at the next valuation. So we do have an external option available that's been available for quite a few years now, to be able to insure against tier 1, tier 2 ill health, and this is with Legal and General. But out of our around 270 employers, only 29 have taken them on. And often it's taken on after there's been an event that's really stung an employer. So number of pension funds again are now do something which is self-insurance. And this reduces the risk across the whole of the fund and for the employers. So this is something that we're currently looking at. And what it does, it creates kind of a notional ill health reserve within the fund, and it can cover the tier 1 and the tier 2 ill health liabilities. So these are the really costly ones where benefits are increased, sometimes fully up to retirement age and sometimes by 25% up to retirement age, depending on the tier. But these are the ones that really hit your liabilities. And we're also looking so that it can cover death in service, because again, 3 times salary, that can be a very big figure suddenly having to be paid out. So over the next couple of slides, I'm just going to explain how that works. And thank you to Barnett Waddingham for the slides that I've pinched. So the reserve is built up. So within your contribution rate that you already pay, there's an element of that that allows for ill health retirements and death in service, just based on statistical probability of how often that might happen. So you're already paying for an element of this. If you take out the external ill health, then you're still cash neutral on that as well, because we just reduced the contribution rate coming in. So that portion gets used to create this ill health reserve, notional ill health reserve. So all employers can contribute to that, but we will be having discussions with employers, because there may be some large employers that think, do you know what, we can suck up that risk. That's fine, we're big enough, so if we have one, it's really not going to make a difference given the size of our overall membership. So this isn't something that's everyone's going to be forced upon. So here you can just see you've got your employers, they're paying in their contribution rates. As normal, you'll just be set your contribution rate, but an element of that will be put aside into this notional ill health reserve. So that reserve is in there. So we have an event. So for example, we've got an employer, they've got assets of 100, liabilities of 140. So they've got a deficit of 40 here, be that 40,000, 40 million, whatever. They have an ill health retirement. So something happens, one of their scheme members unfortunately is seriously ill, can't continue to work, gets tier 1 ill health retirement, and that adds another 40 onto the strain. So your assets are still only 100, but your liabilities have now gone up to 180 and your deficit's doubled to 80. So if you think when you got your next valuation, the impact that that might then have on your ongoing contribution rate. So this is where the ill health reserve comes into play, and that ill health reserve is used to pay across that additional 40 back to that employer. So their assets have now gone up to 140 and the liabilities are 180. So the deficit is still 40. It's unchanged. So it's used that reserve to cover the risk of that ill health retirement. So the actuaries work their magic and adjust this just at every valuation. So you won't see this, you won't see money moving in between, but at the valuation that would be adjusted through the reserve and to adjust your assets to take account for any events that have happened. As with anything though, there's always pros and cons. So just looking at the benefits, it's not an additional cost. There's already something in the contribution rate, and whether that value, depending on how that reserve gets used each 3 years, that a cost for ill health will be amended as part of the valuation process. It manages the risks that are outside of your control. You can't do anything to stop ill health retirements. If you're gone through the process and your medical advisor has suggested that yes, it should be a tier 1 ill health, it's your decision, but you have to take into account what the medical advisor says. So it really is out of your control. It's much simpler than the external insurance because it's all done within the fund. You don't even need to think about it. It protects the funding position for you, as I've shown on the previous slide. And it removes that risk of you suddenly getting that huge strain that's going to force up your contribution rate and make the scheme unaffordable for you. It's very efficient for us. It's all done as part of the valuation process. So it's a bit of extra work that Barry and his team have to do. And unlike an external option, there is no profit element. So with Legal in General, obviously, they will be making a profit out of the insurance. That's what they're doing it for. So this is all within the fund. There is no profit. It's just pure, the cost is taken into account. There are a couple of drawbacks, though. There is some cross-subsidisation. So in 1 year, you might not have any ill health retirements or any deaths in service. Someone else will have, and they'll take some money out of that reserve that you've been paying into. So there will always be an element of cross-subsidisation. And the other kind of drawback is that the fund itself is then retaining the risk. It's not going out to a third party. So if we had some awful event where suddenly we had a third of membership go on ill health, then that would impact the fund considerably. So it's not without its risks or without its drawbacks, but we do believe the benefits outweigh that. So the next steps in there, we'll be having discussions with the largest employers. Potentially they may want to opt out, although we do have one of the larger employers that takes out the external ill health insurance anyway. We'll have discussions with those that already take out the LGIM insurance. Will it consult with all employers as part of the funding strategy statement consultation that we do following the valuation? So there'll be more information in there. We'll share more information about how it actually works. I'd be happy to take any views now, though, if anyone's got any. Or if not, if anyone's got any questions, you can come back to me later, or obviously once we're out to consultation or we're having those separate conversations. So I've got no questions in here. Is there anything online? No? Okay. Right, so if that's it then, I shall now swap seats with Barry and hand over for Barry to take you through the 2022 valuation process.
Thanks, Joe. Good morning, everyone. Just to introduce myself, so I probably haven't met most of you before. I'm Barry Mackay. I'm a partner at Barnett Waddingham. We took over as actually the fund just over a year ago now, but I've been involved in looking after LGPS funds for longer than I care to remember, certainly over 15 years. So I've looked after LGPS funds, both the large and small, up and down the UK for some time now. I'm going to talk today about the 2022 valuation. This is the triennial funding valuation, so it comes around once every 3 years. It's the biggest piece of work we do for the fund. And it takes the best part of the year from 31st March 2022 to 31st March 2023. So this is what I'll cover today. What is a valuation? There's lots of different kinds, so we'll talk a bit about this one in particular. How do we value your assets as an employer? We'll know, Joe's already talked about the asset value of the fund, but how do we proportion those assets out to the employers? And then what's a bit more difficult for us is how we value the liabilities, and we'll talk a bit more about the detail of that. And then what you can expect from the 2022 valuation, both in terms of results and timetable and that sort of thing. And lastly, as employers, what can you do to help yourself and the fund throughout the valuation process? So I should say happy to take questions as we go, either from the room or virtually, but I'll carry on and Claire will let me know if there are any. So there's lots of different valuations. I say this one is from an actual perspective is probably the most important one, and from a fund perspective, this is where we set the contribution rates for the next 3 years for each employer in the fund, and that gives us a chance for us to check that the fund is on track to pay all the benefits. But there are other ones, of course, for example, the accounting standards that we do annually. And Joe's already mentioned things like outsourcings and cessations that we do valuations for. But this is the big one. This is where every single employer has a valuation carried out as at 31st March 2022. So how do we do it? So there's different parts here. The first part's the liabilities, and that's the financial promise to all the members. So each member will have built up an accrued benefit, we will know how much that is if the data's accurate and correct, but we need to place a value in that, and by value we mean that benefit will be paid from when the member retires to when the member unfortunately dies, and there may be a dependence pension as well. So within that amount, we need to try and work out how much the fund needs to pay all those benefits, because the LGPS is what we call a funded scheme. So you've got a big pot of assets already set aside to meet those benefits, unlike the unfunded schemes, public sector schemes, where it's a pay-as-you-go. So the contributions that come in are then used to pay the benefits at the other side. So there's a lot of work in the liability valuation part, and we'll talk a bit about that. Assets are a bit easier. We take the market value of assets as at the valuation date, and we do some what we call smoothing. I'll talk about that later on. We look at the strategic asset allocation, which then allows us to work out what we think the return might be in the future on assets. And then the last part, once we know the assets and liabilities of each employer, we can work out your funding position and also the future cost of benefits. So the last part's what the contributions will be for each employer in the fund. And it's always the objective of the actuary to balance what we call solvency or prudence. So looking after the fund and making sure there's enough in the pot to pay the benefits, with affordability and stability for employer costs. So we need to make sure we do that adequately. So if we talk about assets first, it's relatively straightforward. It works a bit like a bank account. So we have the market value of assets for the whole fund. We need to proportion that into effectively pots for each employer in the fund. And the way we do that is we take the assets at the start of the period, which in this case will be the assets you had as an employer at 31st March 2019, the last valuation. You'll have all been paying contributions in, so that's a credit to your account. And the fund will have been paying pensions and other benefits out, so that's money coming out of your pot. And of course, you'll hopefully have been achieving investment returns, which Joe talked about earlier, and those returns are added to your pot. So works very much like any other kind of investment fund, but the part for us is to proportion all those, proportion the whole fund out to all those employers, and that gets us the assets at the end of that period, which in this case will be 31st March 2022. So that's how the asset side works. Fairly straightforward. The liabilities, on the other hand, first of all, we need to get the membership data in, because then we'll calculate the member benefit for every member in the Lincolnshire Pension Fund and what they've accrued at that point in time at the valuation. We'll then need to make lots of assumptions about what we expect to happen in the future, and those assumptions fall into two camps. One will help us determine the amount of the pension, so something like inflation, because members' benefits increase in line with inflation every year, so that will tell us what we think the amount will be by the time that member comes to retirement. And demographic assumptions, so things like how long will people live, because that will tell us how long the pension is paid for. And of course, the longer people live, the longer the pension is paid for, the higher the cost. So there's lots of assumptions. You can imagine a 20-year-old starting employment today. They could work for another 40, 45 years and then receive a pension for 20, 25 years thereafter. So we are making assumptions for out to anything up to 70 years out from the valuation date. So the point is we'll definitely get it wrong, which is why we come back and revisit it every 3 years to make sure that the assumptions are still appropriate, and we can review them and update them at that point and make sure the fund is on track to have enough money to pay the benefits. So once we've got the data in, which is absolutely, I should stress that, it's absolutely key that that's accurate and correct, because that's our starting point. So we then put the data into our sausage machine and assumptions in and crunch the numbers, and that will give us the liability for each individual employee and therefore employer. So the data being correct is the starting point. If the data's wrong and we've got the member benefit wrong, then everything thereafter is going to be slightly out. So that's a plea to provide accurate and complete data if you can. Thank you. So we'll then run our models to get the value of the liabilities, so the accrued benefits at that point in time. We know the assets, we've now got that for each employer, and therefore we know whether the fund is in surplus or deficit, whether it's 100% funded or more, or less than 100% funded, and we'll know that for each employer, and the fund will know what each employer's surplus or deficit position is. And that feeds in to the contribution rate. So there's two parts to the contribution rate. The first one is the primary rate. So that's what used to be called the cost of future benefit accrual, which is a far more intuitive name than the primary rate. So it's the cost of the benefits that are going to accrue to employees over the next year. So when you're paying contributions in, a large part of that will be to meet the cost of all your employees accruing benefits over the next year, which is based, of course, on 1/49th of their pay. The second part of the contribution rate is now called the secondary rate. It used to be effectively the sort of deficit contributions. So from the previous position where you saw that we had the assets, liabilities, and therefore the surplus or deficit position, the funding level, we'll look at that for each employer. And if you have a deficit, we'll ask you to repay that back over an agreed period of time. So the secondary rate becomes an addition to the primary rate to give you the total contribution rate. And if you have a surplus, then in some cases it's possible that we may reduce the primary rate depending on what type of employer you are, how far you are along your period and the participation period in the fund and so on. But that's the adjustment for your employer-specific circumstances, it says there. So that gives you the total contribution rate. Because of the time it takes to do the valuation, even though the valuation date is 31st March 2022, those new rates they've come into effect from 1st of April 2023, so the following year, and then they're in place for 3 years thereafter. So that was a quick run through of the valuation basics and how we do the calculations. Any questions on any of that? Okay, I'll move on. So what can we expect from the 2022 valuations? There's been a lot going on over the last, well, almost 3 years now, and we'll talk more about that shortly. But lots of uncertainty, lots of volatility. It's been a tough time, I guess, at times for pension funds, but everything's bounced back. So it's looking fairly healthy at the moment. We'll talk a bit more detail about the assets shortly. But in terms of the timetable, the way this works is the fund, or West Yorkshire, will provide us with membership data, and the fund will provide us with cash flow data, hopefully by the end of June. We as the actuaries will validate that and make sure it's fit for purpose and complete and accurate and so on. And we aim to do that by the end of July. We then start running the calculations, and we have first of all, we calculate the whole fund results based on what we call the ongoing or the funding assumptions, that are sort of central set of assumptions and central approach. And then we discuss those results with the fund and make sure we're happy with the assumptions and so on. Once we've agreed those and we know what the whole fund position is, we go back and start running the employer calculations. And so as employers, we expect to provide you with your individual results in a schedule in October. So hopefully that gives you enough time for budgeting and for discussions with the fund and so on, if required. So October, November time, we expect to provide the individual employer results. We then have to sign off the formal report and what we call the rates and adjustment certificate, which is the certificate that sets out the contributions for the next 3 years by the end of March 2023. And even though we're often finished the valuation quite a bit of time before that, we tend not to sign off the report until almost the last day. And the reason for that is that, as you'll probably be aware, there's always lots going on in the LGPS. We're always wary that we sign off the report and then something comes out like a McLeod remedy or whatever, and we have to revisit the calculations in the report. So it's just safer to hold off until near the end of the period. But the key point, I guess, for employers there is we expect to be issuing report results and a results schedule in October, November time. This is a large caveat before we get into the expectations for the valuation results. Every employer is different, and every employer's results will vary, and there's a whole host of reasons for that. First of all, you'll all be in a different starting place when we look at from the 2019 results and what you've been paying in for the last 3 years. Secondly, you have different membership profiles, which impacts the contribution rates. So, for example, if you've let's say a leisure centre and you've got a lot of young staff, that means your primary rate that we saw earlier will be lower than for say an employer where the staff's much older, say in their 50s. So that's a big impact on the primary rate. Your experience as an employer over the last few years, your membership experience will also impact your funding position. So things like whether you've lots of leavers or early retirements, ill health retirements that Joe spoke about earlier, a larger or smaller salary increase and that sort of thing. So every employer is different, and therefore the results will be different. So what I say in the rest of this is a sort of general direction of travel rather than the results for your employer as an employer. So just a bit about the main assumptions here, and where we think the direction of travel these assumptions are, and we'll see in a second why these are so important. It was the first one's discount rate. Now the discount rate is effectively a proxy for the investment return, or the long-term expected return on investments that you hold as a fund. And we call it a discount rate because we have to be prudent. So where the LGPS regulations effectively say the action needs to be prudent, and by that it means if you took the best estimate return, best estimate by definition might mean you've got a 50-50 chance of being above or below that number. Then being prudent means we'll lower the bar slightly, and that gives it weights it in the favour of the fund, so that there's a better than 50-50 chance of beating our discount rate when we take into account the assets you're holding that Joe talked about earlier and your strategic asset allocation. And effectively the way you fund the pension scheme, there's only really two sources. There's the assets plus investment returns, and there's the cash going in, the contributions going in. And so this slide here with the arrow pointing down is just to evidence that or illustrate that if we assume a lower discount rate, that means we're effectively saying we're expecting less return on the assets that the fund is holding. So if the return's gone down, then the cash needs to go up. So effectively what happens, the lower the discount rate we use, the higher the value we place on the liabilities and the future cost, the primary rate. So a lower discount rate has almost the opposite effect from what you may expect. It means that the liabilities go up and you'll need to pay more in because we're expecting less return on the assets. And vice versa, of course, if we assume a higher discount rate, then the value of the liabilities come down, cost comes down, and because we're expecting the assets to do the heavy lifting. And I'll explain, it's quite complicated this time around in particular because we've taken your previous actuaries had a discount rate, and we've rebased that, and now times have moved on. We'll come on to that in a second. Inflation is an absolute key assumption that impacts every member's benefit because members' benefits increase in line with CPI inflation. There's been a lot of chat recently about higher inflation in the short term. and we think that's likely. But of course, as I said earlier, we're looking out for the long term. We're more interested in 20, 30 years, and we use the long-term expectations for inflation. So it has edged up a little bit, but not as much as you're maybe or you would maybe think from reading the news and so on. But that will have upward pressure on the liabilities and the cost, because we expect inflation to be a little higher than it was back in 2019. And then the main demographic assumptions is longevity. How long will members live? Which is, we can get a very good handle on this now with all the data we have, and we do carry out lots of fund-specific analysis. We've got a team of experts, longevity experts back in at BW, who will do all this analysis for us to set the assumptions. But of course, it is still quite uncertain, particularly around the last events of the last couple of years. I don't have a specific slide on longevity today. Our view is that even though we've been all through a terrible time, and the number of deaths has increased, there's been a lot of what we call excess deaths because of COVID. We don't think it's going to have much impact on the valuation, that experience. We've already done this work for a couple of funds, and there's two reasons, I guess. The majority of people, unfortunately, who have been dying from COVID were older. Anyway, they were in an older bracket, and therefore their pensions wouldn't have been paid for that much longer. So the point is, the liability was relatively small. And secondly, a lot of those members had maybe were at risk anyway, and we'd already assumed that they wouldn't be getting a pension for long. So there's not a big impact on the pension fund from what's happened over the last couple of years. The bigger question is what we think it's going to do to longevity in the future. Do we think this has impacted how long people are going to live from now relative to what we thought 3 years ago? And we're doing lots of work in that at the moment, and there's lots of different schools of thought which we could go into. But on one hand, it could be that people are going to live longer because we're now all more conscious of viruses and wearing masks and social distancing and so on. It could be that more of these viruses occur in the future, and therefore that dampens future life expectancy. So we'll need to wait and see. So what's happened to the assets since the last valuation? Very, very strong performance. So in the 2 years, 9 months to December 2021, the fund has returned in excess of 30%. So that's a fantastic result. So Joe mentioned earlier, you can see the fund kind of peaked at just over 3 billion back in 31st December, and markets have come back a little bit since then. There's a big dip, of course, at 31st March 2020 when the pandemic was happening, and markets got panicky and collapsed quite a bit, and you're down at 2.1 billion. But they've rebounded really strongly. I should explain there's two lines on this chart. There's one that's very jagged and volatile. That's the actual market value of assets on a day-to-day basis. And then there's a smoother one you can hopefully see through that jagged line. The smooth line is what we do for the valuation approach. It's what we call the smoothed assets, and it's to try and take care of events like the pandemic, where you can see if we had carried out a valuation at 31st March 2020, the funding position would have dropped quite dramatically. You would have lost 15% or so on in the funding level. Because pension funding is a long-term game, we don't think that's appropriate to set or to calculate your funding position on a given day. So what we do is we smooth using market conditions 3 months before a valuation date and 3 months after the valuation date. We smooth out those short-term volatilities, and you can see what's happening here at round about that time. It would have kept your assets at a more We're at a higher level, but also we think a more realistic level, because you can see what happened thereafter. They bounced back quite quickly. And in fact, the smooth line then kind of started tracking quite closely to the jagged line again. We can see the same happening at the very end, on the very right-hand side, where markets have dropped off a little bit since December, but our smooth assets kind of stay a bit more stable. So that's what's going on. What's going on there. And then the liabilities. It's not all about the assets, of course. Assets have done really well, but unfortunately the liabilities always continue to grow as well. They grow with interest. They grow because more members are accruing benefits. They grow because inflation has been added to pensioner benefits and so on. And they, of course, grow with any changes, or they may decrease, but they've grown on this occasion with changes in assumptions. And again, you can see the two lines. We've got the sort of day-to-day mark-to-market liabilities based on assumptions on each day, but then we smooth them again, and we smooth those conditions to be market conditions so that we're consistent with the way we value the assets. So you can see the same thing happening here. In March 2020, the liabilities would have fallen a bit, but in our case, we keep them a bit higher, and therefore the assets and liabilities move in the same direction at least. With some other funding approaches, that's not the case, but we try and our economic model keeps the assets and liabilities moving the same way, and therefore that keeps the funding level a bit more stable and contributions a bit more stable. The last thing on this chart, this is where it's slightly complicated. So the table underneath, on the left-hand side, those are the assumptions that the fund used at March 2019 with the previous actuary. So the discount rate was 4%. Their assumption for long-term CPI was 2.3 and salary increases 2.6. One of the first things we did for the fund was to replicate those valuation results, and then we rebased them onto what we would have used as assumptions at March 2019, and they're shown in the second column. So our discount rate, our the expected return on assets assumption was a bit higher. We thought that the fund would do a bit better per annum than 4%. And we also thought inflation might be a bit higher in the long term. Fortunately for us, both of those things have probably turned out to be true. But that's just to rebase the liabilities, so we've got our own starting point. And then the last column is where we are at 31st January, so what's happened to markets since then. I spoke about inflation going up, so we can see CPI's creeped up from 2.7 to 3.1, and the discount rate, the expected return on assets has come down slightly. And that's because assets have done so well. We're thinking, well, where's the returns going to come from over the next 10, 20, 30 years? So that's an important point to note, as we'll see in a second, because those assumptions have a kind of a big impact on the value placed on the liabilities, and that's because of the sort of power of compound interest, if you like. And the real key point here is the difference between the discount rate and CPI, because you've got CPI increasing benefits and the discount rate bringing them back. And so we've gone from what was 1.7%, the difference between the 4 and the 2.3, the last valuation, to 1.4%. So a slight change in assumptions there. So all that, what does that mean for the fund? That all comes through in this table here. We've shown what was reported at the last valuation. What we would have reported if we were the actuaries, we thought the fund level would be up about 97%, and where the fund is at 31st January. So the good news is, at 31st January 2022, we were 100% funded. So a small surplus now. Remember what I said about employers earlier, everyone's different, you all have been in a slightly different place. This is the whole fund, but at that point in time, you'd have been fully funded. Now, of course, that's a couple of months away from the valuation date. We've got the Ukraine crisis going on, and we're not quite sure what's going to happen to markets over the next couple of months, so it could be a bit jittery and uncertain, but we'll take care of that using our approach. But that's a very healthy position to be in. And this is just a reconciliation of how that's happened since the last valuation. So I've ignored what the previous actuary reported to keep things a bit simpler, and I've shown here what our results would have been at 31st March 2019 and then followed it through to where we are now. Red is a cost, so red's bad news for the fund, and green is good news. That's reducing the deficit or increasing the surplus in this case. So first part's fairly minor. Interest, you've got a small debt, so you have to pay interest on the debt. But the big ticket items are, if you look at the next two, as employers, you've all been paying in contributions, and the fund's been paying, to pay for the benefits building up. And so those two blocks, you can see you've paid in a bit more contributions than the benefits have built up. So that's helped to effectively get rid of that deficit that you had of the 60, pretty much. The next few blocks are all about the assets and the liabilities in terms of the change in assumptions. So investment returns have been very, very strong, and you can see this large green block of 320. That's what it's been added to in excess of what they actually assumed. That's excessive returns, so 320 million. So fantastic result there. And then the next two blocks are what we talked about a second ago in terms of change in assumptions. So the discount rates come down slightly from the 4.8 to the 4.5, and that's added a bit to the liabilities, and inflation's gone up from the 2.7 to the 3.1. So again, that's added more to the liabilities. And then the last block there is the pension increases have been lower than was assumed at the last valuation. So putting all that together, you come out with a small surplus at 31st January 2022. Any questions on any of that? There's quite a lot in that part. Okay, so what does all that mean for the 2022 valuation? So we think the funding level is going to be up, notwithstanding a disaster in the next couple of months, but even then we would be able to smooth some of those short-term volatilities out. So an expected improved funding position, which then leads into a possible reduction in some of your deficit contributions, the secondary contributions we spoke about earlier. However, because inflation's increased and the discount rates come down slightly, that puts upward pressure on the primary rate, the cost. So the primary rate might be up, the secondary rate might be down. So what we're going to do is try and keep contributions as stable as possible and keep them roughly where they are at the moment. So that's our objective. So in terms of budgeting, I would be saying kind of budget for the contributions you're currently paying would be a fairly safe bet, notwithstanding all employers are slightly different. Okay, just on to the last section. So what can you do now to help the fund? So I mentioned earlier that the foundation for all this work that we do and the assumptions we make is based on the membership and cash flow data. So a plea again to provide that as promptly with accurate data as possible to the fund. If there are any employer events, that the fund aren't aware of, could you please let them know, because that also feeds into the funding strategy and our calculations. So outsourcing, for example, was mentioned earlier, but there could be other things like you've closed to new members or whatever. Then that would be helpful too. And then if you're starting to think about budgets and from what I've said, if there's any concerns, then we can start discussing that with the fund in terms of affordability and so on. But I think that was all I was going to say, but happy to take any questions.
Hi, Judy. Would you like to ask your question?
Thank you very much. Judy Benson from PSPS. My question goes back to the assumptions that have been dependent on. And we looked at discount rate, inflation. Mortality is the one I'm particularly interested in. Working within HR, and I suppose anybody going out to work and seeing people, I'm very conscious of the impact that working longer is having on colleagues of mine, people in the community, and that's everything to do with the state retirement age. Is this seen as a factor? Because the way I look at it, I see a lot of tired people that ordinarily would have retired between 60 and 65, carrying on to the age of 67 in highly demanding physical and mental jobs. So I'd really like just to understand, you know, is that the case, that it could have an impact, or is there not a lot of evidence? Thank you.
Okay, thanks for that. It's a good question. And again, there's always different schools of thought in this. It probably depends on your specific job function. So I agree with your point. I agree that, and I think it's also coupled with, you might want to say affluence, or the fact that some people have to work on longer, and we have actually seen a slowing down of life expectancy improvements, not just because of COVID, but actually since 2011. So very broadly, since about 1940, introduction of the NHS and so on, people were living roughly 2 years longer per decade, and it was almost like a straight line if you drew a chart. When we reached 2011, that changed and it started slowing down. So people they were still living longer, but they were living, say, 1 year per decade rather than 2. And there is some evidence, I guess, to suggest because of the financial crisis, because people were more people in poverty and so on, times were a bit harder, then it was potentially linked to some of that. And so what you're saying, the point you make about people working longer, funnily enough, there's evidence that contradicts that. Some people who work longer are therefore mentally more active, and they actually live a healthier lifestyle. But there are job functions that I agree that will have the opposite impact, and I think it's another reason why we have to analyse this in more detail now, because there's bigger differences than there possibly used to be, or at least we were aware of. So I think the answer to your question is yes and no, depending on what your job function is. But our longevity guys take everything into account, even down to, so to look at occupation, or at least proxies for occupation in terms of salary and income. They look at where you live exactly, in terms of postcode. They look at the obviously age and gender and all these other factors, but they take as much data as they can to come up with a good picture of how long people live on an individual level.
Okay, thank you, Barry, very much.
Right, it doesn't seem that there are any other questions. So thanks, Barry. If you want to just swap seats now with Josh, and he will run over the monthly data submissions and payments. Thank you.
Okay, morning everyone. So as Joe's just said, I'm Josh. I'm hoping a lot of you will recognise my name because I'm forever emailing employers about just about everything submissions and payment wise. I'm also regularly in contact with, I've got to change the slide. I'm also regularly in contact with payroll providers if you use them. However, as I'll highlight later on in the presentation, as the employer, it's your responsibility not to payroll providers if you do use one to get contributions in on time. As Joe said earlier as well, just a reminder that you are, or your employees are members of the Lincolnshire Pension Fund, not West Yorkshire Pension Fund. West Yorkshire Pension Fund provide the admin services for Lincolnshire, have done since 2015, which is why, particularly in my role, I have a lot to do with them, and you may hear a lot from them, but your employees are members of the Lincolnshire Fund. So hopefully, as you know, your monthly contributions, the deadline each month is the 19th of the month following payroll. All the information on the returns is very important, but pay is probably the most vital. That is what effectively links to the pension that your employees will eventually receive. As employees in the fund, as Barry's just highlighted, there's a valuation going on, and a new employer rate will be calculated. So at the moment, you're still using previous employer rate from the previous actuary. New employer rates will come into effect as of 1st of April 23. Your employee rates are set out in statute by central government. They should be contributed as a percent of pay, as should your employee contributions. So what goes wrong? What happens when it does? The most common error I find is with your employee contribution rate. So when you submit your return, I'll see the figures that come in. I don't see it at a member level. That's just what West Yorkshire see. I see it at a sort of top line level. And that makes it a lot easier for me to identify if the employer rates being submitted at don't quite tally with what you should be contributing at. If we receive a return which is showing an incorrect employer rate, I'll contact you as the employer, and normally also your payroll provider, just so that we don't end up with people sort of playing pig in the middle, so that everyone's aware of what the situation is and what needs to be corrected. As I say, I can only see the total figures on the returns. I can't see individual member data, so I can't often comment on specific issues. I can just identify the problem and make you as the employer aware. Any specific member issues would go to West Yorkshire to resolve. Free West Yorkshire Pension Fund assistance is available if you do ever have queries prior to returns being submitted. We would find that a lot of problems are easier to sort prior to returns coming to us, because once a return is submitted, it's not very easy to back out the system. It just means that come the next month, you then have to put corrections on yourself. We then need to monitor it. So if you're ever unsure on anything, it's always best to contact us early. So as I said briefly, if you use a payroll provider, is it their fault if things go wrong? Well, no, it's a statutory responsibility as you and the employer to ensure your monthly contributions are received correctly and on time. That's why if employee contributions are ever received late incorrectly, or payments received late, we haven't actually issued many administrative fines this year. We do issue them occasionally, and those fines will always come to you as the employer, not to the payroll provider. If you choose to pass those on to your payroll provider, that's at your discretion. That's nothing to do with the fund. So what happens if things go wrong? Wrong pay figure, wrong pension for your members, as I said earlier. Getting the data to us on time and correctly is crucial. Following on from Barry's presentation, this is a lot of the data that feeds into the actuary and the valuation. So it's crucial that this is correct. You could end up with incorrect data in your accounts. If you're telling us the wrong information, it may mean that things need to be corrected. It may mean that your financial data is therefore not correct as well. Incorrect information, again, as part of the valuation, could lead to potentially higher contribution rates, higher deficits, which I'm sure you wouldn't be too keen on paying us more, just for the sake of a few admin errors. And as I said, admin fines from the fund are possible. The fines that we issue are fairly minimal. Normally, I think it's £136. However, where there are significant issues, we can report employees to the pensions regulator. They have the power to impose fines of £50,000. So just in case you missed it, same slide. Can't say this enough. It's your responsibility as the employer. It's nothing to do with your payroll provider. You pay them to do a job, but it's your responsibility. They're your staff. Any issues, any errors will come back to you as the employer to resolve. So looking back at the year 21-22, there has been improvement in a lot of areas. As I say, we haven't had to issue many administrative fines. Compared to 2021, the data quality has improved quite significantly. More submissions coming in on time, more payments coming in on time. We very rarely actually have any late payments at the moment. So thank you very much to you all as employers for getting everything to us on time. Occurrences of incorrect employer rates, however, have been creeping up. So although we're getting the information on time, it's not necessarily always at the right employer rate. Normally that isn't something West Yorkshire would pick up because they can't see the data on a whole level. They just looked at it on member level. That's why when a return comes in, you'll find I probably contact you the day after if there is an issue with the employer rate. On occasion, when we've got employers that are part of multi-academy trusts, so there's, say 10 or more schools in one academy trust submitting data, and employer rates are incorrect, it can get quite fiddly to backtrack and to liaise between yourselves, between payroll providers, between West Yorkshire to get that corrected. We've had some occurrences that have gone on for a number of months and need quite a lot of staff time from all parties to get things corrected, which is why it's really important, if you think there's going to be any problems or you're not sure about anything, to contact us prior to submitting your returns. Because of the issues with employer rates, we are having to take a tougher stance on these. So previously we'd work with employers if employer rates are coming in consistently incorrectly, but it wouldn't normally be something that we sent an admin fine out for. However, because of the number that are starting to come in, there's no rhyme or reason. It is just the odd month normally for employers, but because of the number that are starting to come in, we are taking a tougher stance. We're going to give employers 3 months to make the necessary corrections, and that's not a rolling deadline. So once an error is identified, as it says, the clock starts. So if your March return comes in with an incorrect employer rate, you'll have until your June return to get that all corrected. If an incorrect return comes in, as I say, you can't resubmit that. The corrections need to come in on future returns. Please do keep in contact. I think Joe said this at the start with other issues in the fund, but please keep in contact. We will work with you to find solutions if you're having issues, particularly with smaller employers. I came across a few throughout COVID where employees who don't use payroll providers but are perhaps smaller, looking at parish councils mainly. If the parish clerk goes off sick, for example, there may not be anyone else who has the ability to submit the return. So we just need someone to let us know if possible prior to these things happening so that we can work with you to find a solution so we can perhaps extend a deadline, ask you what you can get to us and when. And also it means that if you have had an email from me saying that contributions are late, you'll probably know what I mean. It's got about 14 paragraphs of information on it. You won't get those from me. It won't stress you out, hopefully. As I say, we can work with you. If you don't let us know, though, we can't do anything about it. We will class your contributions as late. That can lead to an administrative fine. My contact details are at the end of this presentation, but I presume a lot of you will have them anyway. As I say, I email a lot of you a lot of the time. Looking forward to March data and cash contributions. The statutory deadline for us to receive contributions is the 19th of the month following payroll. So your March contributions are not due to us until the 19th of April. However, with March being end of financial year, with it being evaluation year, it would be incredibly helpful if your March contributions could come to us by, or before April, basically. As I say, I can't stress this isn't a compulsory deadline. The statutory deadline is still the 19th of April. Obviously, I know people have different pay runs and things like that. The dates don't always tie up. If you can get anything to us prior to April, though, that would be a massive help. Just to recap, that was a whistle-stop tour, so if you've got any questions, please do let me know. Feel free to contact me at any time, even if it's not necessarily contributions related. If you don't know who to contact for a query, then I'll probably know someone who can help with that. Monthly deadline, as I've said several times, 19th of the month following payroll. If you can get your March contributions to us before the 19th of April, that will be really helpful. If not, the 19th of April is still the statutory deadline. And free training is available from West Yorkshire's West Yorkshire Pension Fund if required. I do work a lot with West Yorkshire, specifically the PFRs. They really do know their stuff and they are very helpful. If you've got any questions, then direct them to me or directly to West Yorkshire. And if you've got any questions now, please raise your hand or in the room so if anyone has any questions. Nope. Okay.
Okay, thank you, Josh. Don't appear to be any questions on that, but I say it's a regular message from us, so hopefully you've all taken that on board, particularly for your March ones, to assist us in getting that valuation sorted and get your results to you as early as we can. We still seem to be just about on time, actually. So if I can now hand over to Matt at West Yorkshire Pension Fund, and he's going to talk about 20 minutes on the shared service governance. Thanks, Matt.
Thanks, Jo. Morning, everybody. My name's Matt Mott. I'm the governance lead for West Yorkshire Pension Fund, and Jo invited me this morning to talk about governance of the administration service and obviously Lincolnshire Pension Fund and generally speaking the LGPS. Apologies, that's not the most exciting title of the presentation, but that's exactly what we're going to talk about today. So if Claire, you could put that onto the next slide, please. Now, I don't know what you know about the LGPS. I'm new to West Yorkshire, but I do like the LGPS. I'm a bit of an LGPS geek and it's marvellous. It's such a big thing that you're all part of. We are the biggest defined benefit scheme in the world, depending how we count our assets and liabilities, etc. We're somewhere between about, I don't know, 4th and 7th, biggest in the UK, biggest in Europe. And we have assets nationally, England and Wales, of £337 billion. 14 billion of those are paid each year to our scheme members and then to eligible partners and dependent children. And there are 88 administering authorities, just like Lincolnshire, with a membership of 6.1 million members and over 18,000 scheme employers. And these figures are growing on a yearly basis. If that wasn't enough to think, well, we're really good, we've got a history, a really good history. We can trace our roots back to 1890 in the poor law reforms, where some of the earliest pensions were awarded to the managers of asylums in London, broadly based on their service and their pay. However, it wasn't until 1922 that the first regulations were written, and even then, membership wasn't automatic for everybody. And to be in the scheme, you must be invited to join by your employer. The latest and significant change to the scheme regulations were in 2014, and I'm sure you as employers are aware of the change, the information that's required, the data that's collected. As Jo, Joshua and Barry have articulated today, there is a lot of information, a lot of requirements. That scheme change was prompted by Lord Hutton's review in 2011, where amongst other things, he said that the LGPS should be transparent, affordable and fair to all. Now, those regulations, thankfully, are not made by me or West Yorkshire or Lincolnshire or any of those 88 administering authorities. They are made by Parliament. So we are a statutory scheme. So for want of a better word, these regulations are law, which is brilliant for a scheme member, because we know the pension benefits are determined in law and we will get our pension. But I do accept for pension professionals, whether it's the fund, the administrator, our actuaries, and certainly our employers, it can become a challenge, because whether we agree or understand or have the resource to deliver the regulations, unfortunately, we have to do just that, deliver on the regulations. Can I have the next slide, please, Claire? Thanks. For employers, there are so many requirements of the scheme, and they've all been, a lot of them have been spoken about in depth, better than I could put them. But I suppose one of the most important, if not the important one, is maintaining contributions. Even as Joshua said, they should be paid by the 19th of the month. And the value of those contributions, Barry said, are set by the fund actuary, and so many different details are considered when the values are set. But those contributions are paid into pension funds, and those pension funds are used expressly for the administration of the LGPS, and the biggest cost is obviously paying pension benefits. Now, although it's not really happened, what should be aware, employers should be aware, that if the fund values fell significantly or there was no fund at all, that those pension liabilities wouldn't be able to be met. And in such an event, the liabilities would fall on the employers and the employers' costs would increase. And we really don't want that to happen. Next slide, please, Claire. Here in Lincolnshire, we've got 75,000, over 75,000 scheme members and over 270 scheme employers. And I think that all of the employer types have been touched upon. I think Joe in the first presentation, councils, academies and admitted bodies of private sector companies. The good news is there is over £3 billion to spend on 75,000 people. I know it's not as simple as that, but it sounds quite good as a headline. And the scheme manager has the overall responsibility for the fund. And I'm going to reiterate a point that's been made a couple of times. The scheme manager in Lincolnshire is the county council, the Lincolnshire Pension Fund. And Lincolnshire, as the scheme manager, has to implement the rules. They have responsibility for their own part of it, but they also have responsibility for ensuring that everybody else involved in the fund delivers the scheme rules too. So that's employers and even the administrator at West Yorkshire Pension Fund. Next slide, please. Now, as part of their process of delivering the scheme rules, is they have their own decisions, and there's just a sample here, which are in the regulations, so they're law, they're mandatory. So Lincolnshire control the admission agreements. Now, by that, I mean they will assess any new requests for an employer to join the scheme. And again, Joe touched upon TUPEs and outsourcing. Well, it's really key to talk to Lincolnshire before employers get into this process, because if a new or proposed employer doesn't meet the criteria, so there's not enough guarantees, there's no bonds, they don't indemnify themselves to meet contributions and liabilities, Lincolnshire can say, no, you're not going to join. Now, the problem with that is if you as an employer have outsourced an element of your work, you've already started the contract, what happens then if they can't come in? That actually could threaten the life of the contract. Equally, contracts end and employers may need to leave the LGPS. In such circumstances, they will be assessed to see if they owe the fund some money. And if they do, Lincolnshire will arrange for that money to be collected. It's essential that they do this, because if they don't, that liability or deficit will sit in the fund and actually arguably could then become a deficit shared by other employers, and we don't want that either. Now, death grants is the sole discretion for the pension fund, or the payment of them is, and that might sound a little bit weird because as scheme members we have nomination forms that we may complete. But actually, some of us don't complete those forms. Some of us complete them and we have, material changes to our life and we don't review them. And sometimes family and friends fall out so they can contest a payment. So in any of these events, it's the absolute sole discretion of the pension fund to decide where that death grant may be paid. Abatements. Well, you might not know what an abatement is. If somebody was employed and they were already an existing pension member and receiving payment of their pension, there can be a limit or an upper earnings limit applied by the pension fund. It's entirely up to the fund whether they want this to apply or not, and they have sole discretion. Transfers, lots of rules around transferring into the pension fund, but the pension fund themselves will have control over perhaps some of the time limits. Conversely, employers also have discretions, and these are mostly mandatory. These come with a certain amount of consequence, whether that's cost or consistency in implementation. An example of these would be something like the Rule of 85, which allows membership pre-2008 to be paid at the age of 60 without an early retirement reduction, because normal retirement age is now 60, well, it's state pension age, so between 66 and 68. What the employer could do is decide to implement that rule from age 55, so 5 years early. Equally flexible retirement, one of only 2 examples I can think of where a scheme member may remain in employment and receive their pension. In terms of flexible retirement, there has to be a reduction in working hours or in pay grade, and that's at the discretion of the employer. Normally, when someone receives payment of their pension before their normal pension age, it will be reduced for early payment. What our employer can do is can waive that reduction so that someone could retire as early as age 55 with their pension paid fully. At the same time, if they were extraordinarily generous, they could award the scheme member additional pension. And again, like the pension fund itself, the employers could have some say in certain types of transfers, but again, it's a discretion, and there are already lots of rules around pension transfers into the fund. Next slide, please, Claire. Now, I mentioned the consequence of decisions and discretions. Most of them are fairly simple to overcome. The regulations say that employers must make their discretions and have a policy published. Now, it's easy enough to publish it. You can put it on your own website. You could give it to West Yorkshire, put it on our website, or the Lincolnshire, and that would be great. But then it needs to be reviewed. And the reason and the issues that could be caused by not publishing it or not having policy at all would be inconsistency. There'd be no knowledge from line managers to HR departments to administrators. Even the pension fund themselves may not be aware of what should happen in certain circumstances, like flexible retirement or award of additional pension, which means some members may benefit from this, it be awarded, and some members may be turned down. When you get those inconsistencies, you'll get queries, complaints, and if it gets to an IDRP, it may end up in front of the pension regulator. If that's the case, you'll end up with sanction. If it involves a high worth complaint or many numbers of your employees, could be reputational damage. And if the benefits have been put into payment at the request of the regulator, I'm pretty sure there's been an inconvenience or stress caused to the scheme member, so there might be a further compensation. So even ignoring the cost element, the time to work this, the time, the resource, the understanding, the stress for us as individuals working in the scheme, it's just easy to comply with the regulations, have a policy and publish it. What employers should also recognise is that almost all early payments, if they're unreduced, will be an additional cost to the employer. It's called the strain on the fund. And if you do allow your scheme members to retire early, with their benefits unreduced, you should be looking to get an estimate or a cost from the administrator. I know Lincolnshire policy is as soon as these people retire, the strain on the fund would be due the following day and payment will be due in full. Just because you weren't aware of the amount, or if there was a cost at all, or you had no budget, wouldn't negate the need for payment. So please contact the administrator or the fund if you have anybody leaving early. Next slide, please. Now, the shared service is a layer, if you like, of support or control, of knowledge beyond the LGPS and beyond Lincolnshire. Now, there's a couple of things that I'm going to pick up here. Two words. One is administration, the other one are partners. And I know Jo set the scene on her presentation, the first slide or two. The administration service is for the everyday running of the scheme. So that's the implementation of scheme regulation. It's about the exchange of data and knowledge. It's about the calculation of pension benefits and obviously the payment of pensions to shared service. It is not, and this is probably a bit of a hammer to crack a nut, but it is not anything to do with that £3 billion fund or the management or the investment of it. Each partner within the shared service has its own individual and separate responsibility to manage and invest their own pension funds. So this shared service is just specifically about the administration. Also, there's no dominant partner. That's a good way to put it. We are partners in the true sense of the word, like-minded pension funds that want to improve the administration and our service to our scheme members, which means collectively we are sharing our knowledge, we are sharing the responsibility of the regulation, and we're sharing the costs of the administration, which you should know is one of the lowest in the country. I can understand how people perhaps misunderstand that you are part of the West Yorkshire Pension Fund. After all, there is one central point of contact for employers and for scheme members, but that's necessary to actually comply with regulations and receive data and pay pension benefits. The truth is that as the administrator for Lincolnshire Pension Scheme, West Yorkshire Pension Fund actually work under contract or SLA for and on behalf of the Lincolnshire Pension Fund. Next slide, please. What we can achieve, though, and what we have been achieving since 2015, is we've been able to throw a resource collectively at the shared service to the administration that we wouldn't have been able to do on our own. We develop, we change, and we modernise what we're doing almost on a daily basis, it seems, and we support each other, our employers and our scheme members. We've developed so many good and robust policies and processes that if we were asked to share them or we were challenged about them, even by the pension regulator or the ombudsman, we would be very confident and willing to share that information. Although each fund has a responsibility to ensure the regulations are applied collectively, or individually, sorry, collectively, we can assist each other. We can talk about best practice and what's worked in one area and see if it works in another. It just makes the implementation of these complex regulations a lot easier. The same goes for communication. We have the resource, we have the expertise across those 4 areas. So we'll be able to draw on that knowledge. We're able to put the communications out there, whatever type it might be, whether it be a statement, a letter, electronic or website. But not only that, we have the resource to be able to review, take the information down and put the next set of new, current and relevant information on our websites. This is a lot of data between the 4 funds, and even with the employers at Lincolnshire, it runs the numbers of the amount of data that we have runs to millions of different fields. I read or I heard the government actuarial department saying that there were up to 51 separate pieces of information per scheme member. Now, if that is true in Lincolnshire alone, we probably ask for about 14 million pieces of data a year. And you should be aware that we take the security of that information incredibly seriously. And we don't just meet GDPR requirements, we exceed it. But you also should know that to meet our legal obligations as an administrator, that data may be retained for up to 100 years. So you can see that knowledge is key here, and what we're working towards as a group of like-minded funds is a consistent understanding and a consistent service, not just through our own funds, through our funds, through the boards, the administrators, employers, but also across the 4. Consistent knowledge, consistent understanding, consistent implementation of scheme regulation. Can I have the next slide, please? This process is supported by the pension board, and there's a pension board at each fund. Now, they're relatively new. They were introduced with the scheme regulations in 2014. And although they are non-decision making boards, in other words, they can't make decisions on what we do, how we do it, they do have a statutory obligation to support the scheme manager, so support Lincolnshire. To do that, they need to receive information about you, the employers, about us, the administrators, about our scheme members, our processes, what we do, how we do it, why we do it, etc. They receive training on all aspects of the fund, and they attend seminars, conferences. They also get performance reports and KPIs. And to challenge the scheme manager, they will ask, why was that done? Why was that information late? Why didn't we get the data? Why didn't we get the contributions? Why are those pension calculations incorrect? They challenge us. And it's our duty to go to review our processes and our policy and what we've done, and to answer their question, go back, well, it was this, it was that. We've now noticed there were some errors, or we've noticed there was a delay, or it was a soft, whatever the problem is, we go back and we respond to the board. By doing so, we're reviewing and improving our processes. If we don't, or if they don't like our responses, then the board can ask us to attend a meeting. And as their remit is based in the scheme regulations, we would have no alternative but to attend those board meetings and answer their questions. Next slide, please. Now, the board itself, if you like, has its own manager. It's the Scheme Advisory Board, a national board that has an ambition for high and consistent quality administration throughout England and Wales. And they have commissioned a governance review that took a few years to complete, partly because of the pandemic. And they have produced a couple of reports with some recommendations. And some of these recommendations we expect to be included in some amended regulations. And we hope, if not expect, but hope it would be supported by guidance from DLUC. Now, the points below are just a couple of the main ones that I found in the report, and I think are quite key to how governance of the scheme will look in the future. So those 88 administering authorities, including Lincolnshire, may have to name one single officer responsible for the LGPS. Now, it's likely to be perhaps a senior finance officer or a Section 151 officer, but they are responsible there for the delivery of the LGPS in that county or in that fund. They will also have to publish a policy on how they would deliver the scheme regulations. They would also need to publish a conflict of interest policy. Now, I know at Lincolnshire there already is a conflict of interest policy. I know it's there as part of the boards, but now that might be expanded to include other committees or boards that are involved in the scheme administration. Also, assessment of training plans. We know that the current pension board have to demonstrate knowledge and skill, but this now may be extended to other committees and boards. But it would be no harm if that was also extended further, and maybe advisors, administrators and employers are also assessed for their knowledge and skills within the LGPS. And equally too, a roles and responsibility matrix, where we would start at that single named officer, and the matrix then would run through the boards, committees, the fund, employers, even actuaries and administrators. In fact, anybody that has any involvement, their role would be highlighted and their responsibilities stipulated. A policy on employer representation, as far as I know, is quite new. It'd be interesting to see how these different interpretation of this policy may be across the country. Certainly some employers have opportunities to be represented on pension boards, and it'll be equally interesting to see how many employers do take advantage of this opportunity. Now, that does sound like quite a bit of work, but please bear in mind that if that sounds like a lot of work, then all of this would have to be reviewed every 2 years by an independent governance review body. Can I have the next slide, please, which I think is the last one. Now, we could be a bit worried about some of this governance, because at the first glance it might appear that it's a lot of extra paperwork and red tape. But actually here in Lincolnshire, I'm not entirely sure that would be the case. Certainly there'll be more work for us all to do. Certainly we need to keep improving what we do. As Joshua said, there are some things that aren't perfect and they need to be worked on. But generally speaking, my understanding from Lincolnshire, what I hear or heard as an outsider before I joined West Yorkshire only 3 or 4 months ago, is Lincolnshire Pension Fund is very good. And if you look at this slide, which I put together initially for pension funds only, but actually works for everybody involved in it, because you've got pay slips and P60 production for employers. Employers implement HMRC limits, the valuation and the McLeod remedy. We're all working on that. You know, we want to remove discrimination. You know, employers provide the data ends up in figures on benefit statements. They form the basis maybe of benefits we pay. Collectively, we do an awful lot and we do it really well. So I actually think, even though the potential for these new governance reforms, if I can call it that, will cause us more work, I don't think it should cause us any concern. Because from what I understand at Lincolnshire, I think you're already demonstrating some of the things that Lord Hutton said in 2011, and that is that you are transparent, affordable, and fair to everybody. And that is my last slide. You'll probably be glad to know. If there are any questions, happy to take them. Or, as I think Amy is next and she's touching upon some similar things, if there are questions, you might want to hold off until after Amy's presentation. Thank you.
Well, thanks very much, Matt. I don't know if there are any questions in here. I can't see any on the online. So over to you then, Amy. Thank you.
Okay, thank you. Good morning, everybody. I'm Amy. I'm the Employer Relations Manager at West Yorkshire Pension Fund. As we've already established this morning, West Yorkshire Pension Fund are working in partnership with Lincolnshire Pension Fund to administer the LGPS for all of your scheme members. So I'm going to take you through a brief administration update today. If you can have the next slide, please. So over the next 20 minutes or so, I'm going to give you an update on our team, so on the employer relations team, which is formerly known as the communications team. I'm going to cover a couple of topical items that may or may not require some action from yourself. So this is going to include McLeod, your employee discretions, and also scheme leavers. I'll talk to you a little bit about employer training that we have available at the moment, and then I'll conclude with some bits on my pension and also a little bit on member engagement. Next slide, please. Okay, so firstly, I have got 2 new faces to introduce you to. So you may or may not have seen these names being bandied about if you're following Pension Matters, or if you attended our engagement forum last week. But we have 2 new pension fund reps who have joined the team. So that means now we have 5 pension fund reps that make up the bulk of the employee relations team. So we have Richard Quinn here. He has come with a really strong background in customer services and also experience in LGPS and blue light schemes. So Richard is currently looking after all of our Barnet employers, but he's also looking after all employers that have their payroll done by EPM, which does include a chunk of schools in the Lincolnshire Pension Fund. We've also got Ahmed, who comes with a strong background in relationship management. At the moment, Ahmed is looking after a group of admitted bodies in the West Yorkshire Pension Fund. But over the coming weeks and months, Ahmed will begin to take on a chunk of admitted bodies in the Lincolnshire Pension Fund. So as it stands at the moment, the majority of employers in Lincolnshire Pension Fund are being looked after by Kaylee, who hopefully you've all had dealings with over the years. Kaylee does a great job of supporting all of the employers in the fund. But as I say, over the coming weeks and months, that will be spread a little bit more thinly over the new team members. We will, of course, keep you updated of any changes to your pension fund rep details. So we will email you when we've made those changes to keep you informed. Okay, next slide, please. Okay, so this slide is just to outline exactly how the pension fund representatives can help you and can support you with your roles and responsibilities of being an LGPS employer. So these include things like employer training, employer workshops, employer meetings and visits, which are all conducted online at the moment. Pension fund reps will help you with membership audits. We will also conduct meetings with members with limited life expectancy. We'll work with the communications team to support member communication, so things like member presentations or pension surgeries. The pension fund reps will support on those types of events. Just to reiterate a point that Josh has made earlier today, please do get in contact if you do have any questions around your responsibilities or the processes that you need to get involved with. We're very, very happy to help. Go through any queries that you've got, because obviously it's much better if we get data in accurate in the first instance rather than trying to address errors and queries later down the line. So just to reiterate that message, please do reach out for assistance if you need it, and please do attend our training that we do very frequently, and I've got some more details on the upcoming training that we've got coming up. Next slide, please. Okay, so a little bit on McLeod. So hopefully you're all very familiar with that term, and you have picked up on quite a lot of the communications that we've been sending out over the past year or so. There may or may not be some work for you to do as an employer, but essentially what we have done is we've produced a file, 2 files actually, which will require you to check and verify the information on there. So one of those files contains all of the service details for any members in scope. So that's all the hours changes for those individuals. And then the other file will contain all of the details of the service breaks that we have on our records. So what we need you to do as employers is to check that information is correct, and let us know either if it's correct, then great, or if there is any amendments to be made to individual members' records, we will need to let you know. Let us know so we can make those changes. Now you can access these files via the employer portal, so you can see the screen grab there, where you can see the top 2 files are the files that require your attention. So if you just skip to the next slide, please. Perfect. So we obviously need you to review the files. If the data is correct, so if all of the hours changes and all of the service breaks showing on those files is correct, then it is just simply a case of dropping us an email to let us know that you checked the information and you're happy that it's correct. If there are any amendments that need to be made, you will need to update these on the spreadsheet, maintaining the format of the spreadsheet. That's really important so that it can feed seamlessly back into our systems. So if it is incorrect, you'll need to make the changes and then submit that data through the same system that you submit the monthly postings file through. If you have any questions on this, in the first instance, if you get in touch with Stuart Duncan, whose email address is on the slide there. Okay, next slide, please. Okay, so employee discretion. So Matt's already covered in a bit of detail about the different types of employee discretions that you must have a policy on. Hopefully as well, if you attended our employer engagement forum last week, you'll have a good understanding of these and also a good understanding of what actions you need to take. But in a nutshell, every LGPS employer must have a policy written and published on the mandatory discretions, and also we need a copy as well as the scheme administrators. So we've recently done an exercise to assess who has a policy on our files, who has an outdated policy. If you fall into either of these categories, we have sent you a direct email. That was early February time. So if you have received that email, please do give that your attention. If you need any help or support in putting your policies together, we do have a guide which goes into each mandatory discretion in a bit more detail, and also there is some template wording in there which you may wish to use. This can be found on our website, which is linked on the slide for you there. And again, if you do need any support or guidance, please do get in touch, and we can help you put those policies together. Next slide, please. Okay, so this is just to touch on scheme leavers. So for anyone who leaves the scheme, of course, we need you to send us an online leaver notification. So anyone who is under 55, it would be a leaver notification that we would need. Anyone who is over 55, we would expect to receive a retirement notification for those members. Now, clearing leavers should be part of your monthly routine. So when you send us your monthly data file, we identify any leavers from that file when we've processed it, and we produce an exception report which details all of the members on there that we assume have left the scheme. So each month, please refer to this exception report and work through the leaver notifications for each person. Leavers is always something that's really important, that obviously you process in a timely manner, but even more so at the moment, as we've covered quite a lot this morning, with it being evaluation year, it's even more vital that any members who have left the scheme, we have a leaver form for those people, because that then allows us to calculate that member's benefits and put their pension record in the correct status. So as a business as usual item, leavers is very important, but even more so at the moment. Next slide, please. Okay, so a little bit on the employer training that we have available at the moment. So our employer training continues to be delivered online through Microsoft Teams. So the current theme for the training that we have at the moment is all centred around preparing you for year end, preparing you to make sure that your month 12 file is prepared accurately and on time. Now, you can still book a place on the training that we have at the moment. If you just flip to the next slide. So we've got a link there to where you can book the training. We do push out messages each week, which includes booking instructions to access your place at the training. So hopefully you're all following Pension Matters and are getting those invitations. So as I've mentioned, the theme for the current season of training is all around the year-end process. So we've got a session on steps to success for your March return. Then we have got 2 sessions on blocks and quarantines. So we'll talk to you a bit about the theory of the blocks and quarantines, and then also how to clear those as well. And then we have a session that is all on assumed pensionable pay, because what we do find is some of the errors that come out of the annual pension statement process are around assumed pensionable pay. So these 4 sessions are best if you can attend them all, because they do follow on and link on from each other. So if you haven't yet had a chance to book on these sessions, it'd be great to see some of you join us for those training sessions. The sessions only last 30 to 40 minutes at the most, and of course they're online, so shouldn't be too much time out of your day to join us on one of those sessions. Next slide, please. Okay, so we've also put together a month 12 file checklist. So this again is really just to help you get in the best position that you can in order to get that month 12 file to us early, on time, but most importantly, as accurately as possible, with all of the key pieces of information on there that we need in order to produce the members' annual pension statements, with obviously minimal follow-up queries in the form of blocks and quarantine. So if you haven't had a chance to look at that checklist yet, I would encourage you to have a quick look at that. Also on there are some other just general good housekeeping points. So a little bit on a few steps that you can follow to make sure that you've done everything you need to do in terms of preparing your data for valuation, but also just some reminders about things like making sure your employer contacts are up to date, which is really, really important. So if you haven't had a chance to have a look at that document, I would encourage you to have a little look at that in a bit more detail. Okay, next slide. Okay, so on the topic of annual pension statements, the annual pension statements will be made available to scheme members via My Pension. Okay, so we publish the pension statements via the individual's online portal, as opposed to posting the statements out to the individual. So it's obviously really, really important that as many members as possible are signed up to access their pension online. So we are in the process of refreshing the marketing tools for My Pension. We also have a short video on our website which explains the steps that members need to take in order to get signed up onto their My Pension account. So there are already a couple of marketing tools available. Like I say, we are refreshing those tools, and we will make you aware when they're available. So it would be really good if you could continue to promote My Pension to your employees as and when you can, just to encourage more people to sign up in preparation specifically for the annual pension statements. Next slide, please. Okay, so this is the current sign up position within Lincolnshire Pension Fund. If you go to the next slide, this shows you how the growth has been really good over the past sort of 3 to 4 months. People are signing up, which is great. But there is over half active members still yet to sign up to access their pension online. So of course we do our own promotions to encourage members to sign up, but we will also rely on you as well as the employer to make your staff members aware of My Pension at any opportunity. So that could be in the induction process, it could be via your intranet pages, payslip messages, anything like that can get the message out about My Pension and encourage as many people as possible to sign up so that they can pick up their annual pension statement. Next slide, please. Okay, so just to round off my update today, a little bit on member communication. So we continue to work with Affinity Connect to provide pre-retirement courses to members. So the courses are still being delivered online. So they're a 2.5 hour course now. Affinity Connect have extended the course and they now include content on lifestyle, estate planning and wellbeing. So really useful content additions to the course. Members can book their place on the course via the website through a self-service booking page, which is really simple. And they have offered course dates throughout the full year. So there is a huge number of courses available for members. So again, just if you feel it's appropriate or useful for your members, if you can promote these courses to your scheme members, to your staff, and they can benefit from attending one of those courses if they are at that stage in their career where they are thinking about retirement. Next slide, please. Okay. So if you did attend the Employer Engagement Forum last week, you will have already heard me talk a little bit about this, but this is something that we are planning as administrators. So this will be a series of presentations for members of the scheme. There'll be online presentations. The presentations will be designed to be as simple as possible, and we will cover all of the aspects of the scheme that are beneficial to the members. So we'll talk to them about the other benefits in the scheme, like the death grant, the ill health cover. We'll talk to them briefly about how their pension's calculated. We'll talk to them quite a bit about My Pension and how they can use it, how they can get the most out of that system. So they'll be very generic, covering the fundamental basics of the scheme. So we are anticipating that they'll be useful to all age categories of members in the scheme. These will be run by West Yorkshire Pension Fund, and there will be multiple presentations available for members to book on. They will be online, and we anticipate that these will be kicking off in the summertime. So when we have more details and when we've put the dates together, we'll let you know. And if you can also promote those to members, that would be really good. Okay, that brings me to the end of my update. What I have got here, just as my final slide, is our contact details. So any queries that your staff have, your scheme members have, they need to be directed to our members helpline. So we've got the members helpline number and the email address there. Then I've included the employee relations team number, which is the 434 900 number. So if you call that number, you will come through to one of the PFRs on the team who'll be able to help with any of the employer queries that you have, or of course you could drop us an email into our team mailbox there. And I've also included the communications team mailbox as well, just for your information. You can of course contact your PFR direct. The contact details for your PFR are on our website. So that is everything that I had to cover this morning. Does anybody have any questions, either for myself or for Matt, from anything that we've covered this morning?
Amy, can I ask when the pension statements are planned to be available on My Pension?
So it will be as and when they have been processed. So it all depends on when the files come in from the employers. Obviously, once we get the file in from the employers, they have to be processed. There may be a number of blocks and quarantines on there that we will rely on employers to correct those errors. The only date that I can guarantee is that they'll be before the statutory deadline, which is the end of August. But it's certainly not going to be one set date for every single employer. It will depend on when that data comes into us, in what condition that data comes into us, and then also how quickly the follow-up queries are cleared. Does that answer your question?
Yes, thank you.
Okay.
I've got two questions, if I can go for a bog-off offer between you and the first one's in relation to the pensions discretions, and in relation to what determines whether they are in date or not. We've set a review period of 5 years with our audit and risk committee, and whether that is sufficient. And then the second one, you talked about the McLeod documents being in our list of available documents. Have they all been issued? Because I've got nothing sat in mine. Thank you.
Okay. I think the frequency of reviewing your discretions is something that that you would decide as an employer. I think it's probably quite good practice just to have a brief review annually of your policy. Of course, if any changes happen to the regulations as well, that would possibly instigate a review, which we would also contact you about. So I think it's very much up to you as an employer as what you would deem reasonable, to a reasonable frequency to review your discretions. I mean, it might just be a case of each year you review the policy, and there may be no changes, but at least you've taken that action, and that you have reviewed it. I don't know if you had anything further to say on that, Matt.
Sorry, couldn't find the microphone there for a moment. Yeah, there's absolutely nothing wrong in 5 years. It's certainly compliant with the regulations. It would, I suppose, as a commentary, seem a bit long, possibly, as Amy said, if regulations change. I think in my experience, I see officer reviews every 12 months, with perhaps board reviews every 3 years. But as Amy said, it is entirely up to you what you think is reasonable as an employer. So I don't know, 5 years, when you think about regulations, how often they change, 5 years might seem a little bit long in the tooth, but there's absolutely nothing wrong with it.
Okay, thank you.
Thank you. And then your second question on the on your files, what I'll have to do is, if you can let me know which employer you're with, and I will have to look into that and get back to you, because as far as I'm aware, they all should have been produced. It might be. They should all have been produced. So yeah, let me know where you are, who you're representing, and I will follow up on that with you.
Okay, I'll send an email via Kaylee.
Yeah. Great. That's perfect. Thank you.
Steve, would you like to ask your question?
Yeah, thanks, Joe. This is probably just an open question to the panel. We're starting to get sort of questions from our members, our client members, around our potential exposure, if anything, to Russian interests as a result of the ongoing, so obviously ongoing issues in Eastern Europe. Do we know if the pension fund has any sort of exposure to Russian interests, especially in respect of, oil and gas areas as well?
Yeah, thanks, Steve. Luckily, I looked at this yesterday, so I can give you some figures. We're still awaiting information from our alternatives manager to see if there is any exposure there. But across the other investments that we have, it's really only in one fund that we have with Border to Coast, which is our multi-asset credit fund, and there is some exposure there to Russia, Ukraine, and Belarus is the other one, but actually the amount of it across the whole of our element of that sub-fund, it's only approximately 2.4 million. So this is 0.08%.
Oh, it's very small then, yeah.
Approximately of the fund. So there's no material impacts. We've actually got a meeting with Border to Coast this afternoon to talk about the exposures that we have. They have some other exposures in their emerging markets fund, but we don't hold any units in that. So just how they're dealing with this with managers, what information they can provide us. And obviously it's such a fluid situation at the moment that this is something that, our managers are all keeping us up to date on, and we'll be ensuring that we're doing the best we can to protect the assets, but then also keeping in line if there are any sanctions that come in or anything that we need to do to ensure that we're meeting any kind of politically set requirements about investments in Russia, etc. So it's not anything on a financial level, obviously putting everything else to one side, on a financial level, there's nothing really to worry about for the pension fund because it is such a very small amount of money within the fund.
Will the fund be providing an update to members, Joe?
Sorry?
Will the fund be providing an update to members of the fund? It may be questions that start to get asked as we move on into the weeks and months that this will more than likely go on for.
Yeah, I think the easiest way to do that, because obviously the issue we have at the moment with the administration shared service communications is that it comes out through West Yorkshire Pension Fund, and obviously they can't speak on behalf of the four partner funds. So what we will look to do, once we've heard back from the final manager and we have that overall fund picture, we can get a communication sent out perhaps through Pension Matters to all our employers or directly to all our employers, and ask you actually to share that with your members if there are any concerns, because obviously it's much more difficult for us to get out to all 75,000 members, and we will deal with any individual requests and questions that come in. But as I say, it's such a quick moving situation. It's something we'll obviously be monitoring and reporting to our committee and board. We do a weekly update email to them, so we will be reporting at least weekly to those charged with the governance of the fund.
Thanks, Joe. It was in relation to council members rather than individual members of the scheme, but thank you. That would be really helpful.
Are there any more questions? No? Okay, I can't see any more hands. So I think, thanks very much for your attendance, either personally or virtually today. Some of the key messages, hopefully, that you've picked up, there's an awful lot going on in the pension fund. We try our best to look after your money and your scheme members' money as best we can, and making sure we're working that as hard as we can, but also in a very responsible way. Key messages on the year-end returns, your March returns, please, if possible, get them to us early. That would be wonderful. As soon as you can, get them accurately to us, and alongside that, any cash or outstanding deficits that need to be paid by the 31st of March, so that we can get that valuation data to our actuary as soon as possible, because obviously once we've got the correct data, we can also then start getting out the annual benefit statements that Amy spoke about nice and early ahead of that 31st of August deadline. So again, alongside that, please make sure you look at your quarantines and blocks as soon as they start coming out. The other thing, please help us get our employee or employees signed up to My Pension. 8,000 or so active members of our 25,000. So there's a lot of people that haven't yet had any sight of their annual benefit statement from last year. You know, there's going to be a lot more things coming on that My Pension site. So please do help push that publicity out when that comes from our shared service partner. And then just on the valuation, we will, as we have done in the previous few valuations, we'll run a meeting in November so that we can discuss the results, and then there'll be the option for those one-to-one meetings. So we'll keep you informed with what's going on there. Are there any questions or comments that anyone wants to raise then before we call this to a close? No, I don't think so. We'll then just, yeah, thanks very much for your time. Apologies, we've run slightly over, but enjoy the rest of your day. Thank you.
Thanks, Joe.
Thank you.